Facebook's results are out, and management has just finished going through the guidance for fiscal year 2016 on the earnings call. Shares are up about 12% or so to about $105.50. In this video, we're going to take a look at that new guidance, plug it into our earnings model, and see if that price move makes sense. Now, if you're new to our modeling approach, please visit our website, gutenbergequityresearch.com. Click on the Education tab, and from there, there's a document that you can download which goes through our entire approach, and it uses Apple as an example, but the methodology is the same across all our companies. And if you'd like to download this model and follow along or plug in some sensitivity analysis of your own, click on the Free Models tab. From there, you can scroll down to the Facebook model and just click the button to download. So what we have on the screen now on the right hand side is the updated model, which includes the fourth quarter results and management's guidance. And on the left hand side of the screen is the model as it stood just prior to today's release. So now if we get into the guidance that management gave us on the call, they did talk a little bit about revenue, but they never give any specific metrics. Tonight they said that the same factors that contributed to the strong growth in 2015 would continue into 2016. And then they also mentioned that some of that benefit would be offset by some macroeconomic headwinds. So at this point, since there's no additional guidance, we're going to leave our revenue estimates, our growth rates, consistent with what we had in the model prior to the release. And then keep in mind, if you scroll down to the segment details, the way that our revenue line is generated in the model is we separate out the monthly active users by region, and then we take the implied average revenue per user for the quarter, and we multiply the two items together. So we've essentially left those growth rates in monthly average users constant, and we've left those average revenue per user also constant. So keep in mind that this is one area where you could see some variability when analysts update their models tomorrow. And you can also take a look at what the actual average revenue per user was in the December quarter. It came in pretty strong and above our expectations. If you look at US and Canada, we were projecting $11.68 earned for each user in US and Canada, and we actually got $13.54. So that might be one area that you want to change. You could download this model. You could change this $10.15 to maybe $11 for the first quarter if you wanted to see what impact that would have on earnings and valuation. Another interesting thing to do here would be to take the average revenue earned per user and compare it to Twitter. We also have the Twitter model available. That one will need to be updated as we get closer to Twitter's earnings. But if you look at some of the historic results, you can see that the monetization of Facebook is just completely different than Twitter, and they earn so much more per average, on average, per each of their users. So that's some interesting analysis you could also do with this. Next, management gave us some guidance on year-over-year growth rates for total GAAP expenses. So for this, we're going to expand and take a look down below the income statement. You can see that we calculate the growth rate in total expenses, and it's kind of difficult because management doesn't give us any details for cost of revenue or the breakdown between the other OPEX items, R&D, marketing and sales, and general and administrative expenses. So we have to look at all four items together. So you can see that we've set our growth rate equal to the midpoint of that guided range of 30 to 40%. So now we have it at 35% in our model. And we can take a look and compare that to what we had yesterday for 2016. So we had a growth rate of 46%. So obviously expenses are much lower than what the street was expecting. Keep in mind that the view that we had yesterday was calibrated to meet consensus EPS estimates. So when we talk about changes from the left-hand side to the right-hand side, we're talking about changes from consensus to the new updated model, including tonight's results. Next, management gave us guidance for total non-GAAP expenses, and they have set that at a range of 45 to 55%. And they also give us the details of most of those non-GAAP items. So stock-based compensation for the year, they expect to be $3.2 billion or I'm sorry, 3.1 billion to 3.3 billion. And you can see that we've set ours equal to 3.2 billion. And if you look at stock-based compensation on as a percentage of income, or excuse me, as a percentage of revenue, we set it equal each quarter. So we have no variability at this point from one quarter to the next. Then they also gave us guidance for amortization of intangibles, which they expect to be in the range of 700 to 800 million. And you can see we set this to 750 million, again, the same amount each quarter. And that gets us to total non-GAAP adjusted expenses of 49%, which is almost the midpoint of management's range of 45 to 55%. Next, management gave us guidance for the tax rate for next year. So they expect it on both a GAAP and non-GAAP basis to be in the low 30s. So in our model, we set it to 33%, which is much lower than what we had in yesterday's model. So that also was a little boost to net earnings. And they also give us CapEx guidance. So they're expecting between $4 and $4.5 billion of CapEx for the full year. And they did mention that the majority of that was related to the data center, the new data center in Ireland, and then they're still working on the data center in Fort Worth. So for us, we made CapEx a little bit front-loaded in 2016, but we ended up with the midpoint of management's guided range there. So now, after plugging all of those new guided items into our model, we can take a look at the valuation impact. So our market multiple-based valuation moved to $113, and that was from, let's take a look, $104 previously. And a portion of that is the increase in net cash balance. So that's added a little bit of benefit to valuation, about $1 or so. And then on a discounted cash flow basis, we moved from $101 to $119. So using our 50-50 weighting of the two approaches, we went from 102 to 116, which is an increase of about 14%, and now shares are now up 12%. So the results are in fact consistent with what we're seeing in after hours at this point. After all the analysts have updated their models and submitted their estimates, we'll recalibrate this model to meet consensus. So be sure to check our website to download the new updated version in a few days. And if you're interested in financial modeling, please subscribe to our channel and be sure to watch tomorrow for our Alibaba release in the morning and Amazon in the evening. Thanks for watching.